Good evening, everyone. Thank you for joining this session. My name is Sri Krishnan. I welcome you to the fourth webinar session on the Demystifying Banking series. The objective of this series is to attempt and remove the cloak of complexity in understanding banking. And one of the important areas of banking is payments, which is the subject for today. I'm told the profile of the audience today is largely beginners, and we also have a mix of experts around. So we will cover the basics first. Let me introduce you to the contents of today's session. We will talk about how payments are an integral part of our lives and in the financial system. We will also see how we have been paying earlier and how we pay now. We will also introduce the concept of payments and settlements and what happens behind the scenes. And finally, we will also talk about what are the opportunities that lie ahead for organizations that are involved in payment processing. And so this is a 1 hour session, so I would appreciate if you could allow me to answer your questions at the end of the session. But please go ahead and record your questions as and when you have them. Just type the slide number first and then ask the question, or rather type the question, so that we can quickly go back to it once we are in the question and answer session. Is that fine? Now I'll put you all on mute, and at any point in time, if I'm not audible, please type in the question, in the question section to catch my attention, so that if there is something to be done, we'll do it quickly. Okay. Thanks. With that, let's start. Do you recognize this picture? This is the famous painting called Creation of Adam, which was painted by Michelangelo sometime around the year 1511. And this was done on the ceiling of the Sistine Chapel in Rome. This is a very popular picture. All of us would have seen it somewhere. And what's peculiar about this is the Journal of American Medical Association. They published an article which credits Michelangelo with loading this picture with a lot of symbolism. In fact, they said the red color picture on the right hand side with all its figures and all that, it is a perfect replica of a human brain. And of course, there are a lot more about human anatomy which this picture talks about. Our objective is not to go into that, but had Michelangelo been a little more financially savvy, he would have painted it this way. I don't know if you can see the small picture on top of the two hands. He would have definitely put money between those two hands. And yeah, agreed, for the record, this is just a meme. But the point is, payments have existed since the time of Adam. In fact, almost. I'm not saying just Adam, but almost the time of Adam, we've been using payments. Whether we realize or not, we have been making and receiving payments right from a very early age. Whether it is in the form of a game of Monopoly, which we have all played, or when we have done our financial transaction at a very young age where we bought something. Okay, so this is payment is one of the very first financial transactions that we all have performed even before we have been exposed to the world of banking. The only alternative to payment is either transacting free or using the barter system, which none of us can afford right now. So we understand payments have been there for so long. It is intricately woven within the fabric of any financial system in the world. We as a society have understood the need for a common measure of value of goods against an arbitrary unit called money. Now, what value that money carried varied over the centuries. Right from the time gold coins were issued to represent money, we have come a very long way. In the past, we have used metal currency, we have used paper currency, and we have also used leather currency, which required physical movement of these currencies whenever we had to make a payment. All these were just tools. They were tools to facilitate payments. The act of physical transfer of any of these currencies constituted the payment. Now, just like the invention of the wheel allowed us the possibility to transport from far distances, and lifts and elevators allowed us the possibility of living and working in high-rise buildings, the invention of money or currency has allowed us to transact in a global way irrespective of what product or service we are using. Now, while in the initial days payments were largely by cash and required proximity, The moment we started using financial intermediaries, intermediaries like banks or post offices or payment agents, the need for the physical proximity was no longer a requirement or a limitation, right? I hear somebody saying my voice is cracking. Is it still cracking or is it any better? Is it fine? Okay, thanks. So yeah, where were we? We were saying the physical proximity was no longer a barrier, so long as we were using financial intermediaries like banks and post offices or payment agents. Right? As civilization moved from Iron Age to Bronze Age to Plastic Age, payments also moved from metal currency to leather currency to paper currency to plastics, and now we are in a stage where we use electronic currencies like bitcoins. Yeah, I agreed it's not very popular, but it's already an option. And today, with the advent of global connectivity, internet banking, and mobile banking platforms, payments are largely made electronic. Even our day-to-day lives, we hardly use any checks, and most of the payments that we do are electronic in nature. Let's take some of the current popular payment options in the Indian scenario and how we make the payments. The simplest of the transactions that we will do is an account-to-account transaction, where both the accounts lie in the database of the same bank. The remitter and the beneficiary both hold the account in the same database. Now, this is a very simple transaction. The value of the transaction happens immediately. If there are accounts which are present in different banks, then we use either the NEFT option or RTGS option. We also use to have the check option, but since the context of discussion right now is electronic payments, we will talk about NEFT or RTGS depending upon the payment quantum and choice of network that we have. We also use credit card based transactions, and we also have mobile banking transactions. The focus of our discussion today is to just understand a little bit about, or rather scratch the surface on NEFT and RTGS kind of transactions. NEFT, as we all know, is an electronic fund transfer system. I don't know how many of you know, but it operates on a deferred net settlement basis, which settles transactions in batches. So typically there are multiple batches of transactions that happen during the day, and from one bank to another, all these transactions are collected in batches and exchanged with the central clearing house. And if you miss one of those batches, you always have the opportunity to go into the next batch. So essentially what we are saying here is the transaction happens electronically. The transaction happens almost instantaneously. When I say almost, it's not like a check where it takes days for processing. Across the geography of India, you can have the transactions done almost within the same day. And these transactions are netted per bank. Per bank, both the payables and receivables are settled every batch. Every batch they are settled, and they are settled through the RTGS mechanism. Currently, NEFT operates in hourly batches, and any transactions initiated after the designated settlement time, they will have to wait until the next one. Contrary to this, we also have the RTGS settlement. RTGS transactions are processed continuously throughout the RTGS business hours. Now, each of these transactions are processed individually, and individually messages flow from one bank to the other, and the transactions happen almost instantaneously. In both these transactions, both NEFT and RTGS, one of the primary features is that the transaction brings about finality. There is finality in the payment. The moment I, as a remitter, send a request to transfer funds to one of my beneficiaries, the moment the transaction is accepted by the central clearing processing unit and they transfer it to the remitters, the beneficiary's bank, and the beneficiary receives confirmation that they have their account has been credited, that's it. They have value for the payment right away, and there is no possibility of any reversals there. So it brings a very important feature called finality, which is what has made this very popular, in addition to the fact that it gets processed in very little time. So no waiting for value, and as we used to wait for check or collection kind of payments. So this is as close to paying by cash and with almost instant value, with the security of payment by an instruction. I mean, through an instrument. I mean, typically when you pay by cash, it carries its own security risks, whereas this kind of a transaction brings you the security of an instrument-based payment. But at the same time, even though it traverses through clearing networks, the value is received almost instantaneously. In RTGS, there is no netting. Yeah, that is the concept. The expansion itself says real-time gross settlement. The transaction happens in real time, and it is gross and not netted. And each of these transactions, the objective again is to make it instantaneous. We use the although NEFT and RTGS work almost similarly, the mechanisms that are available behind the scenes are completely different. They are very, very different from the way they are implemented. And while NEFT is file-based, whereas RTGS is more SWIFT-based. We also have the IMPS, which is Interbank Mobile Payment Service, which is to transfer funds using the MMID, which is to identify a mobile number plus a person. There are innovations which keep happening around the country, around the world. In fact, this kind of a transaction happened first in Afghanistan, where the account number was the mobile number. So transactions happened, account transfer happened from one mobile number to another mobile number. So it started there, and subsequently that germ of an idea grew, and there were various implementations of this, which we will see during the course of our discussion itself. And with IMPS, it's like NEFT, it's like RTGS in a way that it is electronic. There are no paper trails, and the transaction happens almost instantaneously. And again, the implementation of it is very different, and the background infrastructure that allows us to make payments through IMPS is completely different from what is used for NEFT and RTGS. So these are the three most popular kind of electronic transfers which we use in India. One of the less popular, but still which is very important transaction with respect to financial inclusion is the star 99 hash. I don't know how many of you have heard about this. Typically, whenever we talk about mobile payments, we talk about mobile banking apps-based payments, or we use the internet banking site of the bank through the mobile's browser. This is possible only if you have a smartphone and a data connection. Now, there is a huge population in India which does not have a smartphone in their hands, nor do they have a data connection. To help these people to transact in a very efficient way and also include them into the electronic banking community, the RBI, through the NPCI, which is the National Payment Corporation of India, they introduced this system called the star 99 hash. This allows registered user. Basically, all you have to do is, if I have an account in State Bank of India, I go and register my mobile number with them, and there are certain mnemonics which I use along with star 99 hash, which will allow me to do basic banking querying, like checking for my balance or checking for a credit or a debit. And the beauty is, it also allows me to make a financial transaction or a payment over the mobile itself, just using a feature phone. Instead of using either an internet banking or the smartphone, I can do mobile banking payment using a feature phone. So this is this puts a lot of power into the people's hands, because mobiles are something that we carry all the time with us. You don't have to go to a bank, you don't have to go to the bank during fixed hours, and it is always available with us, and the money transfer happens almost instantaneously. So if you look at it, all these are replacements of cash transactions, which is very cumbersome. The star 99 hash is a very unstructured kind of payment. The reason why I'm saying this is like we talked about NEFT and RTGS being implemented through different protocols and background infrastructure. The star 99 hash actually uses a method called the unstructured supplementary service data, which is common for all banks. with a smartphone, if I have to use HDFC's mobile banking application, I need to have a separate login. I need to have a separate application, or at least I need to go to HDFC's website through my mobile to do the transaction. Whereas if I also have an account with ICICI Bank, then I need to go to one different application or a different website to continue with my transaction. Whereas the *99 hash is more like you calling for your ambulance, or you calling for railway reservation and inquiry, which is why this is standardized across all banks in India. Of course, this is it's available across a subset of banks within India. Most public sector banks are covered, and many of the private sector banks, including ICICI, HDFC, they all subscribe to this. So all of us, I'm sure we have accounts with any of these banks. We can right away try this, or even try this tomorrow to find out how it is implemented. And the beauty is the data is very secure, since they understood that the implementation will happen for people who do not have, or have very poor understanding of security features. The data is not stored at all, so it's a very secure medium in which we make these payments. And to obviate the concerns that this could fall, the mobile itself can fall into wrong hands, there are limits per transaction, cumulative limits per day, which makes it a very secure transaction. And with all these limits, it becomes very uneconomical for someone to do a fraud, because the return or reward they get out of this fraud is very limited. So this is like you put the power into the hands of people and allow them to transact just like other segments of people who use the internet and mobile banking, smartphone banking. And we also have cross-border transactions. In cross-border transactions, we obviously use the SWIFT-based messages. SWIFT is only a messaging system, and we use the Nostro correspondent banking network across the world to make cross-border funds transactions. So this, in essence, is the different types of electronic payments that we do in India. And since we are talking only about transactions in India, we can also talk about how the world makes payments. So we have different implementations here. We have the retail side and the wholesale side. Innovations in electronic fund transfers have happened right from Africa to Europe. We have the world famous M-Pesa implementation, where M stands for mobile and Pesa is actually money in Swahili language. So what happened was, in Kenya, they started this M-Pesa implementation. Again, the germ of an idea started with people transacting mobile currency. For example, I have prepaid mobile and somebody else also has a mobile prepaid mobile. And if I have to pay someone, I just transfer the credit. We have been seeing these ads in India also. This is how the idea originally started, but subsequently it expanded in a way that banking system adopted this. And today M-Pesa is implemented across Kenya without any branches. Typically you can do cash transactions also using M-Pesa. There are M-Pesa agents who are like our mobile currency agents. You go and transfer money to them and withdraw cash from them. So you can do cash transactions, you can do non-cash transactions, and again, all these are retail kind of payments. A similar thing happens in Pay, also. This happens in UK. Of course, the implementation is slightly different there. We also have wholesale payments, which happen in the case of Chaps in UK, and Fedwire, where wholesale transactions happen across the US using the Fedwire network. A similar RTGS network also operates in Europe in the form of Target. We all are familiar with SEPA, which is Single Euro Payments Area. We were talking about how electronic transactions happen in India, and then we also talked about how electronic transactions happen within different countries. M-Pesa was implemented in Kenya, then it went to Tanzania, Afghanistan, South Africa, Eastern Europe, typically in Romania. Then we also have it in Mozambique, Lesotho, Egypt. It's a kind of implementation which is spreading across the world. But the pioneers in this was the SEPA. With step 1 and step 2 clearing systems, countries within the Europe single payment authority, a single payment area, they are able to transact across borders as though it is a domestic payment. Of course, we need to get into the details of step 1 and step 2, which is not within the scope of this discussion. But this transformed cross-border transactions within Europe as though they are paying domestically. The charges are the same, and the transactions happen almost instantaneously like our NEFT, and their implementation, of course, is very different. Similar systems are present across the world. We have the LVTS payments, which is the large value transaction payments, which is like RTGS, like RTFS, and it is implemented in a very, very different way in Canada. Similarly, we also have multi-currency payments within the China area, and also in Hong Kong, where multi-currency transactions are possible. So each of these have built upon what was prevalent earlier, what was popular earlier, and as and when new systems come in place, they are much more robust and much more attractive for users to quickly jump into. All these payments use different mechanisms, different infrastructure, different kind of regulations oversee them. All these are different. But then if you look at it, all payments, there are certain things which are very common in any payment. Let us assume the bank on the left-hand side wants to make a payment to a customer who holds an account with the bank on the right-hand side. There are two very essential components. One is Bank A has to send a message to Bank B. Now, this could happen. The message, the carrier of the message could be anything. Reuters started with sending messages through pigeons, and today we send the messages electronically. But the content of the message, right from the time messages were tied in the legs of pigeons, and the contents of the message that we have today have not changed. They've always been who's the remitter, who's the beneficiary, who's the remitting bank, who's the beneficiary's bank, what are the accounts, what is the debit account, credit account, what is the amount that we need to transact and in which currency, by when we need to make this transaction, and who bears the cost, whether it's the remitter or the beneficiary. So one part is the message itself and what contains in this message. And the second part is the actual money flow. And when we talk about money flow, you can talk about someone physically, taking the cash and then remitting it to the other bank. That's one extreme example which had happened long time ago. None of this happens today because money itself has changed from something physical into just an electronic data record. Today, when what we call as money or what we call as balance in a bank is just some data, data which sits in some database. That is all that money is about. So when we talk about money transaction, it is moving of one piece of data from one bank into another bank's database. So that's all is a money transfer. But that has to happen. Unless that data transfer does not happen, we cannot complete the payment transaction. Right? So when we get salaries, let's say our employer has bank account with Bank A, let's say Citibank, and they make a payment to employees. Say I have an account with HDFC Bank. The file which contains the message is the message part, and the transaction that happens between Citibank and HDFC either through RTGS or NEFT will contain the actual money settlement part. So when we talk about messages, we saw Raja Ravi Verma's painting where that lady uses a swan to pass on her message. Today we use slightly better messaging media like mobile communication, or fiber optic cables, or it could even be a private network like Swift, a very secure private network like Swift. Whereas the concept is the same. And the components of the message, again, like we saw, they are the same. There is no difference. The second part is how the message can be composed. The message can either be a proprietary message, for example, between our employer, the message that Citibank had sent to HDFC Bank, or the message that went from our employer to the employer's bank is a proprietary message which contains data in a specific form which is understood only by the client and the account servicing institution. So this is a proprietary message, example of a proprietary message. This could happen between banks also. There are banks which have a proprietary message communication between each other. Obviously, these are very limited in use, and they do not have the interoperability feature, and this can happen only within a closed group. This cannot be a public network like what we have today. Then we also have standard messages. When we talk about standard messages, there are variations in standard messages. I mean, it looks like an anachronism that we say, on one end we say standard, whether at the other end we also say there are variations. But they are for different purposes. For example, the ISO 8583 messaging standard is used for using the card transactions. For any card transaction that we use, either debit card, credit card, or forex card, they all use a peculiar standard which is governed by the ISO 8583 standards. So the advantage of this is any switch which processes these payments, they know what kind of messages to expect and what kind of messages to converse with. The moment you use standard messages, the scope for error is very less, the speed of transaction is very high, and because the scope for error is less, the costs of a transactions are also very less. Costs in terms of both time and money, because the moment there is an error, you require manual intervention, and manual intervention always costs money and time. And then we also have the ISO 15022-15022 series, which governed our empty series of messages. Swift has the empty series, which will very soon be decommissioned, and we will move on to the XML based messages. And we will also have a uniform payment message across different systems, across different platforms very soon, which will be governed by the ISO 20022. So these are the different kinds of infrastructure that exists for us to enable different kinds of payment systems. Not only messages, not only networks, not only the physical infrastructure or the IT infrastructure is used in making these payments, but there is also a network of banking systems which are governed by central banks across the world. They also have a very large role to play in terms of how they manage risk, how transactions will happen between banks, and they have a very big say in enabling all of this. Now, we've been talking about payments, we've been talking about settlement. Let's see what are the actual differences between payments and settlements, and we'll also see what constitutes a complete payment end-to-end. Now, we will take 3 examples here. The first example is, let's say you go to a shop. You go to a shop, you purchase an article, and you pay by cash. So can we say the payment is complete? Yes, the payment is complete. We have shown our intent to pay the shopkeeper. We have also physically transferred the money by paying the cash, and the other person has received the money and is satisfied that he has received the value of that money. Right? So the payment has happened, and the other person has received the payment as well. He is satisfied. The second example that we will take is, we go to the same shop, we purchase the article, and we pay the shopkeeper by check. Now, the intent is very clear. We have made the payment. The other person has received the payment. He has received the check. He has acknowledged it also. In fact, he will even give you an acknowledgement or a receipt. But in one fine print, it will say value is not realized yet, or only when the value is realized, this payment is valid. So what is this? What does this mean? So the very fact that the check has transferred hands does not mean the shopkeeper has received value of the check. The shopkeeper obviously will have to send the check into the clearing mechanism. It will have to go through 2 or 3 banks, depending upon where each of them have their accounts. And then finally, the remitting bank will have to make the payment, and the receiving beneficiary's bank will have to receive the payment, receive the value of that money, and credit it into the shopkeeper's account, and only then he can say, yes, I have received the payment. And we all know what kind of risks this check transaction can have, right from uncertainty, where you have this, the shopkeeper has received my check, but if my account does not have balance, then he's not going to receive value. And even if my account has balance, he will not receive value instantaneously, but he will have to wait for the check to realize in due course. The third kind of transaction is, third example that we will take now is a card payment. We purchase the article and we swipe a card. And let's assume the card is authorized, the card payment is authorized, which means that the issuer has accepted the liability to pay the acquirer. The issuer is basically the bank which has issued the credit card to me, assuming I'm the one who's purchasing this article, and I have this credit card. I've been issued this card by, let's say, Citibank. The shopkeeper might have an arrangement with, let's say, HSBC. So he has an EDC machine issued by HSBC. HSBC here is the acquirer of the transaction. So between Citibank and HSBC, there is a promise to pay that this card has been swiped and the account, my account with Citibank will be debited, and subsequently HSBC will be paid. Now, the difference between the check transaction and this credit card transaction is the element of uncertainty is removed. There is no longer an uncertainty whether Sri Krishna's account had a balance or not. Now it's only a question of when that value will reach the shopkeeper, and will he receive full value? Because obviously, since we are using different banks and all banks exist to make profits at the end of the day, each of them will have a charge for offering their services. So Citibank will have its own charge and HSBC will have its own charge, and at the end of the transaction, the shopkeeper may or may not receive the full value of the payment. For example, if he has sold me an article for 100 rupees, he may not receive 100 rupees in full, he may receive 97 or 96 rupees. So we have understood that there are three things here. One is what is a payment, what constitutes a payment, when can the payment be called as settled, and what are the different elements that we undergo with each type of payment. So we had a question of uncertainty, we had a question of when we receive the value, we also have the question of the costs for transaction. Obviously, if you look at it, you can say the cash transaction is the most efficient because it does not have any cost or any uncertainty. You will see the value up front and all that. Now, it also has its own risks because there is a scope for fraud. Similarly, in case of checks and cards also, there is scope for frauds and risks which the issuer takes on behalf of the card member. So, like nothing comes free in this world, nothing is fully perfect, but the beauty is how banks manage all this, and that is where we need to understand what goes behind payments and how we will manage them and how we will mitigate them. So with all this, we have risks for individuals, risks for banks, and risks for financial systems. We have had situations where individuals were not able to pay and they pose a risk. We have had risks which banks take on behalf of individuals and suffer a loss. We have also seen that banks fail within a financial system, thereby causing a domino kind of an effect for the rest of the participants in the financial system. So the kind of risks that payments poses systemically is not a small number at all. So we need to get into greater detail to understand what are the different types of risks, what are the mechanisms that are implemented, how NEFT is much better than an electronic fund transfer in another country, how RBI has so beautifully designed the NEFT mechanism, how RTGS, and within the concept of RTGS, how each country has implemented their own RTGS mechanism, and how they handle limits between banks and systemic risk within the financial system. So we can consider payment system to be very robust when all elements of or all participants of the payment and clearing and settlement mechanism form part of it, and they play their part by the rules, and they transfer the value from one party to another. So when we can say, just look at it this way, At the end of it, one party pays another party, whereas the moment we get into the financial system, there are so many things which are involved here. It is not just, we have not even talked about the infrastructure or the actual transactions or the payment engines which process this. Right. So there are three elements. We have talked about payments and we have talked about settlements. There is also a third element which is called clearing, which happens between payment and settlement. Typically, in the transactions that we saw here, these are single one-time payments, so we did not think about a concept of clearing. Whereas now if you were to multiply this transaction into many transactions, many customers of that shopkeeper pay him by check. So there is a need for him to deposit all these checks into his bank, which finally will end up in different banks, and how the clearing happens. Clearing is a mechanism by which different payables and receivables across the participants of a clearing system are netted and the payment made. A similar kind of clearing also happens in card payments. A similar kind of clearing also happens in NEFT or a batch-based transaction. Wherever it is not gross settlement, there is a need for clearing, and there is a need for a clearing agency which will perform this role of acquiring all these transactions, identifying what is the net favorable position or adverse position for a particular participant, and then allowing them to settle through a third party mechanism. Right. So what we generally call about payment composes of payments, messages, clearing, and settlement. So that is the objective of this overall session of introducing payments to you. We have also seen very briefly about what are the risks that are present in a payment system. Obviously, it requires a larger discussion and more time to discuss about how these risks are mitigated. We will now come to the opportunities that exist in the payments area. The moment we talk about payments, the first question that comes to our mind is, if we were to make payment through internet banking, or if we were to make a payment through mobile banking, how safe is it? How secure is our transaction? Will this transaction be compromised? Or using the credentials that I use for this transaction, will there be subsequent transactions using my credentials which I am not authorized? So that's the concern, and it's not a concern just for you and me. One survey said more than about 45% of the people are reluctant to use electronic means for payments just for this reason. Okay, we are moving to a scenario where we are letting our planes to be flown automatically. Autopilot flies the plane for more than 75 to 80% of the time. We have the Dubai Metro where there is no driver. It's all flown automatically, or it is done remotely. Whereas for transactions, we are not very comfortable in the technology that goes around it. And these concerns are not unfounded. There are valid reasons for this. We have enough cases of fraud that have happened. And that is why even though every day we see a new kind of payment transaction or a new mechanism of transaction which comes in, the concern about security is also growing. So we have had authentication mechanisms which have grown. Initially, we used to have a simple user ID and a password, and then we had one more layer of transaction password. In addition to a login password, we also have a transaction password. And to identify whether it is being done by a human or not, we had a CAPTCHA. And then we wanted to find out whether this human is authenticated party or an authorized party or not. We had one more layer called a two-factor authentication or a multi-factor authentication, where in addition to the user ID and password, through one more medium, let's say while we are using the internet banking, we have a one-time password to our mobile, or it could be a token-based system where we have to input one more additional value in addition to just the user ID and password, which is dynamically generated. So all these input-based authentication mechanisms have been in vogue, are in vogue. We continue to use them, but there is a need to move away from them to make it more secure and more robust, and also keep it very simple. Today, I have accounts in 3 banks, and almost on a monthly basis, I have to reset one or the other of the passwords because I keep forgetting them. I have to go to the bank or get it done through some other means. So it's becoming more complex to manage these. So we moved from input-based authentication to an attribute-based authentication, which is either a facial recognition or a fingerprint recognition, where we do not have to input anything. Just by our external appearance, a device reads our face, it reduces the different features or different points in the face into a data point and recognizes us just by looking at us. Similar things happen using the fingerprint recognition technology, which many banks use it. I don't know how many of you have gone to State Bank of India branches. They do not have user ID and password at all for the bank employees. They only have fingerprint readers. So that's one more added layer of security. But we've also seen movies like Mission Impossible, where despite having biometric authentication mechanisms, our thumb can be cut and it can be used. Right. So the more sophisticated the programmers become, the more sophisticated the hacks also become. So that brought about a change in the authentication mechanism, where it moved to internal features or internal attributes like the heartbeat. So you cannot have a dead body to swipe your retina. You need to have a pumping heart, and the heartbeat will be read through a device which will transform the ECG into a data point. And they have identified that each of our ECGs are as unique as our fingerprints, and this is used. Similarly, if you look at the picture next, there is a hand reader, a palm reader. It does not read the fingerprint, it does not read the features of the hand, but it reads the blood flow in our veins within the hand. So you need a hand and you need a live hand where the blood continues to flow. So the risks are less. Obviously, this may be inadequate in the days to come, so we will move into more sophisticated ways. Yeah, we had the retina scanner, we have the iris scanner. Both are very different. So with each of these authentication mechanisms, it brings us one more layer of security, but also adds some complexity. Complexity in terms of how you store the data for people who provide the security, not just for users, but also for people like us who have to implement this in different places. So one area of opportunity is to identify the mother lode of authentication mechanism, which is simple yet very secure for both the user as well as the implementer. So that's one area where many companies are working on. Typically, this is a retail-based scenario where many of these point-to-point transactions where there is a human-to-machine contact or a human-to-human contact based authentication is required. So that's one area of opportunity. The second area of opportunity is on regulation. Yeah, it might look boring, but it's true. There are regulations coming across the world, typically anti-terrorism based, knowing your customer based regulations, or AML based regulations, which is anti-money laundering based regulations, or even tax evasion to avoid tax evasion or tax avoidance. What are the mechanisms that are available? So two very popular kind of regulations which all of us are familiar, or most of us would be familiar, are the OFAC, and which captures all the SDNs, and this is to be done across the world. The second most popular one is FATCA, which is in different phases of implementation right now, where American citizens who are present across the globe, basically America wants to identify who are their citizens who are beneficiaries of certain designated transactions and which are not going through their tax network. So it is essentially to collect tax that is due to the US Treasury, but the implementation is worldwide. So which means that you could be a small bank in Bangalore, you could be a small bank in Vietnam, But as long as you transact in US dollars, you are mandated by the US government to implement their regulation. It might sound a little harsh, but the reality is this. Every bank today, whenever they are making payments or receiving payments, more importantly, they have to ensure that the FATCA regulations are applied. Now, US is not the only country which wants to do this. There are other countries which have their own versions, their own versions of monitoring transactions and different regulations. India has its own regulations. Some of it applies only to India. Some of it applies elsewhere as well. So the problem here is when you talk about cross-border fund transactions. Today we are in a very global economy where the payments happen across the world. So what kind of regulations do you have to build into your payment engines? What kind of regulations that you have to build which are reusable? What kind of regulations apply for your set of transactions? Because the payments happen across the world to different countries. What is that set of regulations that are to be applied for your transaction? So while it is an obstacle for payment, it is an opportunity for organizations which build payment engines. And the opportunity here is how do you build a repository of such regulations and where they have to be applied and how much can you reuse. And today there are organizations which do this as a web service. So as against, they concentrate only on this. They concentrate only on regulation. They do not get into the main payment processing engine, but this is available on the fly where you apply this regulation and format. Okay. So those could be built within your payment engine itself. So that's one type of opportunity that exists today. And the third one is we have seen that right from the time when pigeons carried messages, today our mobile networks carry messages. So the medium or the carrier of the messages have changed. They have changed from paper format to electronic format, and within electronic format there are different varieties. Today we also have near field communication where there is no contact between one device to another device, whereas the payment happens automatically when you are passing through a counter. There are message carriers or message mediums which is called hands-free, where you do not have to carry anything with you. You can have a chip embedded in your palm. It's not hi-fi, it's not science fiction, but there is research going on in having this kind of a payment mechanism. So the medium and the carrier of the message keeps on changing. Again, this is to make it simple and yet make it very secure. And because the medium changes, because the carrier changes, the message formats will change. We have moved from NEFT kind of format. We have the ISO 8583 messages format. We have the MX Swift MT format. We have the MX format. So the message formats also keep changing, and with newer technology, the NFC, they use different kind of formats. Of course, there is a global effort to unify all these messages and have interoperability between different kinds of messages and medium. But overall, there is a growing need to identify how, despite multiple message formats and media, how you can unify all these payments. So that is where the significance of unified payments is getting depicted. So these are the various opportunities that are available to us, and that brings us part of organizations which work in payment mechanisms, in payment building, payment engines, all these opportunities, and that's about it. So our objective was to talk about an overview of payments and an overview of the opportunities that lie, and we have crossed almost 50 minutes. So if you have any questions right now, I'll be very happy to take them. Okay, there's a question from Vinay Kohli. Are there any courses on FATCA or OFAC for a business or function analyst? I'm sure there must be, Vinay. I'm not really aware of this, but I'm sure definitely there are specific courses. But before you get into a course, there is enough material available publicly in the public domain, and you can start off with that. You go in for a course for two purposes. One is to have a better understanding of the subject, or two, to get a certification. I'm sure there are courses which allow us to understand about FATCA. And I've also been told MBL Co, which runs this webinar series, they have their own payment specialist courses which cover OFAC and FATCA to a large extent. So you might want to explore that as well. Okay, thanks. Thanks, Vinay. Any other questions do you have on what we have seen so far? Okay, we have a question from Tilla Rajan. What is the difference between RTGS and RTFS? RTGS is real-time gross settlement, where every single transaction is processed separately, whereas RTFS is real-time final settlement, where it is not done on a gross basis, but it is somewhere between batch basis and gross basis. It constitutes multiple batches which are processed, and within every batch, for example, NEFT is an RTFS implementation. NEFT is not, contrary to popular belief, it is not an electronic fund transfer. I mean, it's plain vanilla netted settlement. Yes, it is netted, and at the same time, it is not RTGS. It is somewhere in between, real-time final settlement. For each batch gets settled, and that gives finality. So, in essence, when till you make a payment to me as Sri Krishnan, if you have got the 10 o'clock batch in the morning, you don't have to, your bank and my bank does not have to wait until the end of day to make this payment. So they will settle between the 10 to 11 batch, and by 11 o'clock, your bank will pay my bank through RTGS, depending upon their adverse or favorable position. And due to this, when I receive the money on at 11 o'clock, my payment is final. And RTFS, we have examples in CHIPS in the USA, which is another implementation of RTGS, and we also have LVTS, the large value transaction system I've talked about in Canada. So these are different examples of RTFS implementations. The parties will, in case of RTGS, the parties will receive money instantaneously. But the banks will make their settlements at a different point in time. So when I receive it, I get my payment, which is final, which is a final settlement. Whereas the bank may or may not get at that point in time. Yeah, again, in the question from Tilai, in M-Pesa or IMPS, how the settlement happens as it is through mobile network. Again, Tilai, this is only the messaging part happens through the mobile network, whereas the settlement happens through the banks. Each of these transactions, they happen through banks. And this is another example actually of RTFS. They are actually low value RTFS. So when you make a payment to me through M-Pesa or through IMPS, I get the funds immediately. Even though your bank and my bank have not settled each other, I get the payments immediately. And both our banks will get settled at a different periodicity. Since this is small value payment, the bank does not have a risk on these payments, and they are not out of funds for a large value. So in IMPS today, the banks pay through RBI on the next day only. In fact, it does not even have the same day. They aggregate all these transactions. A clearing mechanism identifies what is the netted position, whether it is an adverse payment or a favorable position between the banks, and the settlement happens the very next day between the banks. Whereas as far as I am concerned, I have received my payment from you, and I can start enjoying the money right away. Okay, one more question from Tillai. In M-Pesa, I think we do not need any bank account for transaction. Yeah, M-Pesa, where it is implemented in Kenya, it does not require a bank account. Whereas in India, the regulations are so strong that you cannot have a payment system without a bank in the chain. So even in India, where M-Pesa is implemented, it has to be implemented through a bank only. Only thing is you do not know it. In the background, Vodafone uses ICICI Bank's network to make this possible for us. So again, when we talk about M-Pesa, it is the different implementations are very different in different countries. Okay, one question from Arati Menon. Do we have any other forms of multi-factor authentication other than the one you mentioned about one-time password? Yes, Arati. One one example comes to my mind very easily. There is something called as a token, which is a small device like a pager. And I'm saying it is a pager, but apart from the appearance, it has nothing to do with the pager, which generates a random number every time you invoke it. So let's say there is a button in that token. When you press that button, one number appears in the display. Now, you do not press this button at random. Whenever you make a payment, only then you press this button. What happens is, in the background, the same algorithm which generates this number for you in the token, the bank system also has the same algorithm. So, in addition to the password that you type in, I also have to input the value that is displayed in my token. The bank will generate it in their database and will match both these values. If both these values match, then the transaction is successful. So what happens is every time you press this button, the algorithms match and the sequence also matches. So these are implementations where the sequence is important. That is one part. The second is typically multi-factor authentication means there are two sets of authentication through different channels. So one is I can have a user ID password input, and in addition there could be one more factor, which is let's say the heartbeat is measured. There's one more device where I have to measure my heartbeat. Typically, like your friendship bands, there are bands which read our heartbeat as an ECG and transmit this message. So this is used, or your voice can be used to have the second layer of authentication or additional layer of authentication. So now you know about the heartbeat as the second layer of authentication. Okay, thanks. So do we have other questions? I'll wait for a minute more to take more questions. Okay, thank you very much then. I hope the session was useful, and I thank you all. Please continue to attend these webinars on Demystifying the Banking series. There's more to come, and there are two other options for you. One is you can write to us. There is this email ID that you can see on your screen. You can write to us, and you can also talk to us on the phone numbers and get your questions clarified. You can continue to participate in this Demystifying Banking series and benefit out of this. So thank you very much. Have a nice evening. Bye everybody.